So the AI bubble is about to burst, and Goldman Sachs says that most of the AI boom may already be priced in. Even Bank of England warns of growing risk that AI bubble could burst soon. This is the headline of every news that you see today. But in this episode, I will reveal the reality and tell you whether this is true or just headlines to catch more eyeballs. Is there a bubble to begin with? Are we in an expensive market already? Should you buy or sell right now? The answer will shock you because it's not what you think. In this episode, I will answer all these questions like always, and like always, I will tell you the reality, not based on feelings and emotions, but based on data and some interesting graph that justifies my opinion. Before I start, if you think you learned something new from my videos, please give this video a like and let's start. So we are seeing an unprecedented time when only 7 stocks account for more than 30% of the money in the stock market. Imagine someone is building his $100,000 portfolio, and instead of spreading it across a value, dividend, and growth stock, he puts $30,000 in only one stock and the remaining across 499 stocks. I guess you can see the disaster now. Any drop in that one single stock could crash the portfolio. Add to that, this one stock is overvalued at its current price. This is what is exactly happening to the stock market, and that's what's meant by the AI bubble. Stock market kept hitting all-time high after all-time high because the Mag 7 is strong, but underneath the Mag 7 there are many companies struggling in different sectors, including banks, retailers, industrial, energy, real estate, and healthcare. Just because the market kept hitting all-time high doesn't mean that the overall economy is strong, because when few giants perform well, they can pull the whole index up, while other sectors are still struggling. But what really started the fear between investors are 2 reasons. The first reason is fear from huge market crash if AI demand slows. The biggest AI company, which is Nvidia, started seeing a deceleration in growth from 122% to 56%. Well, 56% is still great growth for a normal company, but investors started to worry and massive sell-offs just started. Also, when there are too many people owning the same stocks, this can be dangerous, meaning everyone now owns Mag 7, including ETFs, mutual funds, hedge funds, retail investors, and pension funds. When too many people own the same thing, if selling starts, there are not enough buyers on the other side. And that's what happened back in 2022 when Meta crashed and Nvidia had a massive correction. Another reason that investors think that AI stocks valuation are already priced in, and it's unrealistic. That is not my words, that is what Goldman Sachs analysts think. Imagine someone is driving a race car and at a very high speed, and the crowd are cheering and everyone is happy. At this high speed, if anything happens to the car, even a small tiny mistake can send the car spinning. This is exactly what's going on. If Nvidia, Amazon, Meta miss earnings just by a little bit, we can see $300 to $700 billion can evaporate overnight. And we have seen that back in 2022, and we have seen it back also in 2018. Another reason that I see many people talk about is Buffett's indicator. But before we go to the indicator, I just want to remind you that Warren Buffett is sitting on a record high cash of $381 billion. Now let's go back to the indicator. Buffett's indicator shows that the market is overpriced with a ratio of 220%. Historically, readings above 100 to 120% is considered high. A ratio of 220% is considered strongly overvalued, and that justifies why Buffett is sitting on all this pile of cash. But is the AI bubble about to burst? Is there a bubble to begin with? The short answer is no. There is no AI bubble. The market is expensive, yes, and the valuation is high, yes, and also we are controlled by 7 stocks, which is dangerous, but we are not in a bubble. Let's go back to the definition of a bubble. A bubble happens when companies are valued based on hype, story, and attention, not real revenue, not profits, not hard cash, not cash flow. In a bubble, the market prices company based on eyeballs and clicks, website traffic, imaginary future profits instead of actual financial performance. And when the expectation collapses, the bubble pops. If we go back in time to 1999, most internet companies had no earnings and barely any revenue, and investors bought anything with .com in that name. Companies were valued based on how many people visit the website and how fast traffic grew and future potential with no business model. That's not the case right now. If we go back in time to the dot-com bubble time, companies with zero profits reached multi-billion-dollar market caps. Now let's compare that to the AI boom or bubble, if you want to call it. AI leaders such as Nvidia, Microsoft, Amazon, Google, and Meta are generating tens of billions in profit each year. Nvidia alone had $46.7 billion in quarterly revenue. Actual customers are paying real money for chips and computers. The demand is real. Companies, governments, banks, hospitals, and developers are already paying for GPUs, AI training, cloud AI services, automation, enterprise AI tools. This is not the late 1990s when customers were still thinking about using the internet. AI is here now, and the demand is increasing year by year. I believe we are entering a correction. Yes, most companies are expensive or were expensive at their current price, especially after 3 years of a straight run-up since the 2022's massive correction. A pullback is normal now. Now let's look at data and keep our emotions away. Since valuations are high, a 5 to 10% pullback is healthy. The fact that many AI stocks are down in the range of 5 to 12% range from recent highs aligns with a correction behavior, not a crash. Keep in mind, even if the market crashed 30 to 40% and recover, this does not mean a bubble. A bubble is when companies crash 80 to 90% and never recover, like what happened in the dot-com bubble, and many investors lost their life-saving money. Those companies never recovered because they are not generating money. The only risk that we might face right now is if the gap between expected AI returns and realized returns, which is real returns versus expected, it widens. Then we might see a big correction like 40%, and that's what the hedge fund manager Mark Mobius warned us about. Also, another factor that might play a role with how down we're gonna go is the market sentiment. While business fundamentals are okay, if investor sentiment flips, it can hurt the stocks. When investors say that the AI hype is over and many sell-off starts, you could get a sharper crash. I believe right now it's a great time to buy great companies at a discount because I think next year will be a bull year. With rate cuts on the horizon next year, liquidity returning to the market, and AI demand is still strong. I believe we are setting up for a solid recovery. Not only that, but many factors will play a role next year. If you want to know what are the other factors that will send the market to the sky next year, watch this video.